I'm going to go ahead and start everyone off. So welcome to Nightmare on Tax Street. Today we have Dennis Runkle and Heather Amador with us, and they're going to go through some information about tax filing and cryptocurrency. And I'm just going to pass it on over to Denny if you would like to start on your first slide here.
Sure. Well, thank everyone for taking time to meet with us. And what we're just trying to do here is give a little idea of more knowledge on what's involved with wealth management accounting, why it's important to use all of our services. We've been doing this quite some time. One of the girls who just mentioned, and before this, that we literally have thousands and thousands in our database. But as wealth management accounting has really been in existence for about 2-3 years, but it is the coordination of DR Financial Group, Professional Tax and Accounting, ProDocs document preparation, Reynolds Wealth Management, and I'm trying to think what the fifth one is, but we have 5 that are working together to coordinate for the client's benefit. Meaning, when you have a CPA as a trusted advisor, you have a wealth management person, whether it's a broker or an insurance person, and then you have an attorney. We found in the past that when clients ask one question, they may get 3 different answers that may not make sense at all, as each professional is giving the answer dependent on their expertise. So it creates a lot of confusion, and that's what wealth management accounting is about. How to clearly define clients' goals, help them to prepare for the future, and most important, get a snapshot of where they are at each year to clearly measure their growth towards the goal. So this is just a little idea, as people may be on here that brand new or people that have been clients with us. It's all about having an ongoing educational plan that everybody can just make the tools work better. It's like having a brand new shiny shovel in your garage, and then you forget about the shovel and you end up going out and digging a hole with your hands. Sometimes we feel that way as clients constantly need to be reminded of the tools that will help them achieve their goals. So what my next item slide is the LLCs. Many of our clients come to us with LLCs, and it's a great tool. We highly recommend it, but it's most of the time we find, in fact, I don't know, but time in the last 20 years, we had a client come in with an LLC that was properly structured, meaning they had an operating agreement that allowed them to truly create the LLC as a tax efficient tax reduction, an important part of their tax reduction plan. And we call an LLC that's properly structured a tax diversification tool. Now that's a mouthful, but basically what we're talking about is if the operating agreement's not set up correctly, believe it or not, there's 4 different ways to create an LLC. And if that isn't structured properly, the CPA is not going to be able to take advantage of all the opportunity to reduce your tax liability. And you probably heard this from my team or myself or numerous places. Our goal is when you're a new client is to have a 50% tax reduction from your previous year before you are our client. Now, obviously, if we can knock 50% out legitimately from your tax liability and you put that into a place where it's actually creating you wealth, wow, wealth management accounting is born. Tax planning creates savings that's then turned into an investment that grows towards your predefined goals. So on that slide right here, we're talking about the difference between tax preparation and tax reduction plan. That may sound like exactly the same thing, but they're huge difference. One is reporting history, meaning whatever you did in 2021, the minute January 1st of 2022 came into being, which we've already passed, there's not much you can do about changes or tax planning for 21. So our focus is in the last quarter of 2021, October, November, December, that we're meeting with our clients, implementing the tax preparation / tax reduction plan. They have to come together. So Heather is one of our key tax preparers. Okay, well, Heather has been just a joy to have her on the team. She has a Master of Accounting degree. She's been working in the field for 25 years plus. She's an enrolled agent. And I guess as important as anything, she has added so much to our business on helping clients use these tools to create tax efficiency. We don't find that many tax preparers are educated or know how to use the tool to create true tax efficiency. So Heather, you're on.
Okay, thank you, Denny. So the question we want to ask today, do you think of yourself as a business owner, or are you still thinking like an employee? Self-employed people pay more in taxes and they have little or no asset protection. The self-employed people tend to still think like an employee. They know they have to declare their income and they can deduct their expenses, but the self-employed person wants to try to do everything themselves. They figure they're saved money on fees or there's an app for that. The self-employed person forgets that while they're an expert in their field, they're probably not an expert in taxes or financial planning. And this is a great way to maximize your tax liability. So here's what our team can do for you. We help make sure you pay the least amount of taxes legally possible. This means we're going to look at your unique situation and the type of business you're in and focus on ways to reduce your taxes. Taxes are not one size fits all, and having the right team can literally save you thousands of dollars. A team approach is more than just helping you save taxes, though. We're also going to help you with asset protection. So anytime you're in business, you're taking a chance someone may try to sue you. There's always a chance, but the chances are higher when you own a business. There are ways to protect both you and your business and your personal assets. And then we also help with financial planning and estate planning. Financial planning means making sure you have liquid assets available when you need it, and retirement savings that are tax advantaged. And then good estate planning is more than just having a will. It's about making sure your heirs get the majority of your estate and not the government. And it's making sure that you avoid probate court and the associated fees. Good planning keeps your estate from being tied up in the system and gives your heirs immediate access to everything after you're gone.
So let me ask you a question, Heather. I know this is unplanned and you're maybe not prepared to answer it, but as most people think, one CPA office, one tax preparer, they're all the same. How have you seen and experienced that the wealth management accounting, as your important part, can actually help people on their estate planning and asset protection? Because you're speaking of that, and yet you're a tax preparer.
You got to look at the big picture. We've got Chris, we've got Mark, we've got Don, we've got all kinds of people on our staff, and everybody kind of has their own specialty. So we're looking at this at a team approach. So if I don't know something, then I have people I can talk to, and we can talk about it as a team.
It's the ability for each profession to be represented and look at it from their perspective and hopefully agree to a universal plan of action for the client. So they actually have their CPA, their attorney, their tax preparer agreeing on the best possible solution for whatever the client's problem is.
Yeah, it's been fun working here. It's been way different from past experiences where all I did was taxes. We didn't talk about what's your retirement plan, or what's your financial plans, or do you have enough for retirement? It's not something that your usual tax firm does. The usual tax firm we focus on taxes and that's it. Well, if you need something else, well, you have to go call someone else, then go find somebody else.
And how many times, let's go a different perspective. So many times we have financial planners that volunteer, and they do, and they have every best intent to call and discuss the client's tax issues with the tax preparer. In your past, working other places, did you find that happening very much? Where you actually got a call for a specific client problem from an attorney or a wealth management person that included you in on the planning for the client?
That just doesn't happen other places.
Okay, well, I again, we didn't practice this, and I hate putting you on the spot because you might have said, "Oh, it happens all the time." I didn't know. So
No,
continue.
I've
Sorry
really
for
not had
interrupting.
that. I've really not had that happen. More often than not, I get somebody who says, "Well, my mom's cousin's brother told me, I can do this or something," and a lot of times that turns out to be, bad advice. So and a lot of people don't have all the experts. They haven't talked to a financial planner. They haven't talked to somebody about their estate. And sometimes they maybe even haven't thought about it. Okay, so, owning a business is more complicated than most people realize. So if you want your business and all the laws and regulations to work for you, then you need to be ready to ask for help. And like I said, this is where that team approach comes in. So if there's no questions, we're going to move on to some hot tax topics. Okay, so we're going to talk about virtual currency, advanced child tax credit, the 100% meal deduction, and the backlog at the IRS. Oh, and IRA contributions, of course. So first off, IRA contributions. Now's the time. If you still want to make a contribution for 2021, you still can. So the deadline for your traditional IRAs and your Roths is April 18th, which is also the tax deadline this year. It's April 18th. But if some of you have a simple plan or something else set up, you may have until October to make those contributions. So, make sure that you get that done. So, and if you need help deciding how much or how it's going to benefit you, contact us. So,
and Heather, let me again, the simple plan is something we use an awful lot. And one of the most biggest advantages to a simple plan is that if you do file an extension, you have the ability, clear to October 15th, to still fund that for the previous year. Wonderful, wonderful advantage. So go ahead.
And you can also do a company match with a simple. A lot of people don't know that you can do a company match in your own company.
The big reason we love simple pension plans, there's no administrative cost. And the employees love it because there's no vesting schedule, meaning when you match dollar for dollar, and the normal plan is dollar for dollar up to 3% of the employee's wages, that's vested immediately. That's their money. There's no vesting schedule. And it literally matches much larger firms' pension plans, and it's better, and yet the small employer can give it to their employees, very, very little cost and no administration. So that's a pitch for simples, even though we don't sell simples. It's one of the things we recommend as part of our tax reduction strategy. Okay,
so let's talk about virtual currency. That's a real hot topic lately. So just first off, the terms virtual currency and cryptocurrency are often used interchangeably. Cryptocurrency is actually a type of virtual currency, and it's the most well-known. The crypto and the cryptocurrency comes from the word cryptography, which is the blockchain technology that it's built on. Cryptocurrency is decentralized, meaning there's no one government, no central bank, and no organization regulating it. So Bitcoin, Litecoin, Ethereum are all examples of crypto, and they're all becoming more popular every day. So this has led to a lot of our clients asking about crypto for how it's treated for tax purposes, both in investing and using it in their business for transactions. So, and I've had quite a few clients lately. Personally, I've seen a huge increase in clients for cryptocurrency investment from this last tax season to this tax season even. So we've all heard stories about how hot crypto is and how much money people have made. And you may even know somebody who's made money from trading crypto. Tesla's been in the news lately because at one point they were letting people buy an electric car with Bitcoin. So one of the things I want to stress about the IRS view of crypto is that it's a property, not a currency. Treating it as a property versus a cash equivalent makes a huge difference when you're talking about tax treatment. So if you invest in crypto, it's basically treated like you're investing in a stock. So there's no tax impact from the initial purchase. It affects taxes when it's sold, and then it's treated like any stock or mutual fund. So you have either a capital gain or a loss on the sale. Now, the tax treatment depends on whether or not you hold it short-term or long-term and what tax bracket you're in. So if you held it short-term, then it's ordinary income. If you held it long-term, then it's subject to the capital gains rules, which are usually a little more favorable. Okay, I've got a question up here. Can an LLC hold cryptocurrency? So yes, yeah, an LLC can own crypto. It may depend on how you're purchasing your crypto and what platform you're using. So things change when you start using crypto in business, when you start doing transactions in cryptocurrency. And I believe QuickBooks does handle cryptocurrency now. I think at least Bitcoin and a couple others. I'd have to look and see which ones. So if you allow customers to use crypto to make a purchase with your business, you have to remember what I said earlier, that crypto is a property and not a currency. So when you accept a transaction from someone paying a cryptocurrency, the crypto has to be recorded as income at its fair market value. That's whatever the value is that day and the time of the transaction. Okay, so for example, if you own a pizza place and you accept an order for pizza and they pay it with $100 worth of Bitcoin. So the Bitcoin's worth $100 today. It doesn't matter tomorrow if that same Bitcoin is worth 75, you're going to record $100 of income. Later, though, when you sell that Bitcoin, then you've got either a capital gain or loss, because remember, this is a property, not a currency. So suppose a month later, that $100 worth of Bitcoin is now worth 150, and you decide to exchange it for cash. So now you have a capital gain of $50. So you can see accepting cryptocurrency in your business can really complicate bookkeeping and taxes. So that's something you'd want to discuss maybe with us, or something you really got to think about and do your research on before you decide that that's a good idea.
Heather, do we have anyone that's currently using it that way, and are we
Not
in your books? Are we?
I've had people ask about it, and when I tell them how it works, so they kind of, well, I don't know if I want to do that.
I mean,
So,
are we even prepared with our bookkeeping services? And you may not be the one to ask, because Dawn is head of our bookkeeping department. Could we even accommodate and ease that burden from somebody that wanted to do it? Because it sounds like a bookkeeping nightmare, except I think hopefully we could make it much easier on that business.
I think we could. Like I said, QuickBooks does foreign currency, but it also does some of the major crypto, and I'd have to look and see which ones it does. But I want to say it does Bitcoin and a couple others. So, yeah, I don't see why we couldn't help with that. I'm sure down the road at some point it's going to happen. We're going to start seeing that.
This is where I really like is one of the opportunities, as if somebody's taking a lot of Bitcoin, when you sell the Bitcoin could be a whole strategy in itself.
Yes, definitely.
Much different than receiving currency. So people have to understand it could be an added big advantage if you don't need the cash flow to pay your bills. In other words, if the next day it would drop drastically, oh my gosh, I don't want to turn it in now. If you have the cash flow to hold it and wait for the volatility to swing upside, that's a whole nother strategy we'd be glad to help people with.
Yes. Okay, so you probably noticed at the bottom of this slide, we mentioned something called NFTs, or non-fungible tokens. This is something that's still very new, but I wanted to touch on it real briefly because I have had clients asking about it recently. So an NFT it's a non-fungible token. It's a virtual token. It's a type of virtual asset. So these virtual tokens are based on real world objects like art, music, videos, video game objects, and even social media posts by celebrities. They're popular because they represent an asset that's one of a kind or very limited number. The most famous example is probably from a digital artist named Mike Winkleman. I don't know if anybody's ever heard of him. He goes by the name Beeple. He crafted a composite of 5,000 of his daily drawings to create what's probably the most famous NFT of the moment. It's called Every Days, the first 5,000 days, and it recently sold at Christie's auction for a record-breaking $69.3 million. I've actually had a client who's a well-known artist in her area approach me about the tax implications of creating NFTs based on her artwork. So when you do something, this is kind of like a manufactured good. It falls under the same rules of a manufactured good. So you can deduct any associated expenses with creating it and selling it, but you still have to, of course, claim the income from the sale. But any cost that you have in the creation of that would be something that's a business deduction. So then I had another client that told me he's actually started collecting NFTs, and he even showed me his little platform on a cell phone where he's collecting digital art that's NFTs. And he wanted to know what happens when he goes to sell them. Well, remember, this stuff is considered property. NFTs go a little further because they fall under the collectible asset rules. So collectibles normally are things like coins, baseball cards, art, vintage wines, stuff like that. But collectibles, when they're sold, they have their own fixed tax rate of 28% on the gain of the sale. So that's something to keep in mind when you decide to invest in something like this, because that might be higher than your normal tax bracket, but it's higher than the normal capital gains rates. So even if you've held it over a year, you're going to pay 28% tax on that gain. So just something to keep in mind if you ever decide to get into this. So no other questions. Let's go on to our other hot tax topics. Okay, so let's look real quick at these other ones. So advanced child tax credit, most of you with children are probably aware of the advanced child tax credit created by the American Rescue Plan last year. This raised the normal child tax credit from $2,000 for children 16 and under, and it raised it to $3,600 for children under 6 and $3,000 for children ages 6 to 17. So it actually raised the age limit 1 year too, because the old rules, as soon as they turn 17, they're no longer eligible. The year they turn 17, they're no longer eligible. But now they're eligible until they turn 18. Half of this credit that was paid in the last 6 months of 2021 as a stimulus payment, unless the taxpayer opted out. And we did have some people opt out. Now the opt-out process wasn't real smooth. So, but if you didn't opt out, then they're going to expect you to reconcile these advance payments against your income tax return. So you probably received a letter in January. Most of you should have received it. If you're married, you're going to both receive one of those letters. It's letter 6419, and it's going to have, so if it's spouses, you each have half of it listed. And if you're single, it's going to have the full amount of whatever you got ahead of time. So during those last 6 months of 2021, those monthly payments, it should add up to that amount. So, and if you opted out of the advance, then you're going to get the full credit on your tax return, assuming that you're claiming the child this year and your income isn't too high. So if you received, if you receive the credit and you're not claiming your child on your return, then you might have to pay it back. But that's going to depend on your income. So lower income may mean the repayment limitation will keep you from having to pay it back. So there are limitations on it. If you got it and then later you find out you can't claim them or something like that, or your income's maybe a little higher than you thought. So repayment limitations might keep you from having to pay that back. Some of you may or may not know there is 100% meal deduction this year. And this is for business owners who deduct meals in connection with their business. It's normally limited to 50% for most of your meal deductions. However, for 2021 and 2022, some meals are 100% deductible. This is something the restaurant industry lobbied for. The meals that are 100% deductible have to be from a restaurant. And somebody's asking, I've got a question, does carryout count? So yes, carryout counts. It can be dine-in or carryout, but it has to be a restaurant. So ready-made meals from a grocery store, convenience store meals, and kiosks don't count. Okay, and then our last topic here is the IRS backlog. The IRS was already getting behind before the pandemic because of budget cuts. And when the pandemic first started, many of the IRS offices were closed. So now they're millions in the hole. And even last tax season, they were already behind. They're even further behind starting into this next tax season. And some of you may be aware of the problem because last year your refund was delayed or the IRS threatened you with collections when you've already sent them proof that you don't owe anything. I recently heard, and this has been in the news, the IRS has over 5 million pieces of unopened mail. It's literally sitting in trucks parked outside IRS offices. And then there's millions of returns stuck in various IRS departments too. So I even recently ran across a 2017 return stuck in the error department. The client told me they filed it. The IRS was saying it wasn't filed. We later tracked it down to it's stuck in the error department, where as far as I know, it's still stuck there. So, and then amended returns are taking about an average of 4 months. IRS notices can take several months to resolve right now. One of the biggest problems recently has been dealing with the collections agency and trying to get through on the phones. So what happens is we send in documentation to prove a client doesn't have a liability, and the documentation gets stuck because of the backlog in the mail. Meanwhile, you keep getting collection letters, and they keep sending more and more threatening letters. Phone systems are tied up too. They're only answering about 3% of incoming calls right now. And if you do get through, then you're looking at an average hold time of 70 minutes. And I can say even for the practitioners, I've had very few times I've gotten through that it wasn't at least 70 minutes. Unfortunately, there's only so much we can do at the moment. So if you're having issues with the IRS, let us know so we'd see if we can help. We've had trouble, of course, getting through too. And sometimes I got to call every day for 2 or 3 weeks before I get through, but we keep trying. And I know the IRS did say that they did freeze accounts for some people. So a lot of people, the collections process has been frozen recently. So, but they haven't really said, for who and for how long that's going to go. But, let us know if you're having a problem. We're trying to help you get through to the IRS. If we can't get the issue resolved, then we'll at least get the account frozen.
The next question, I'm going to back this up with another one. The fact that we have an attorney on staff, we have tax attorneys that we have access to help. At what point do people get frustrated and need to actually go to a tax attorney? And from your perception, is that work to have an attorney involved?
Well, when the IRS is holding someone's refund, you have the right to, ask for the refund. You can even declare it's causing you hardship, and sometimes that can push them to get it through quicker. But otherwise,
I'm talking more about somebody that has a tax liability from the past and is getting notices that their assets are going to be frozen and things, and yet they're trying desperately to rectify whatever that problem is. That I was kind of going beyond the normal refund. How are you seeing that play out?
One of the problems we've had lately is, like I said, we said, for example, the IRS sent somebody a notice your return was filed late. Well, then what we normally do with those is we mail them a copy of the extension notice, and that usually resolves it. But lately, because the mail is taking so long to get opened, but the collections process is automated, so that next letter just goes out automatically. But it causes a real problem then, because of course they don't really owe that money. The return wasn't late. There was an extension filed, but the IRS isn't opening their mail for, they're several weeks, several months behind opening mail. So then the next letter just keeps going out, and then it becomes, intent to levy and that kind of thing. And it gets scary then.
Yes.
Yeah. So what we do is in those kind of cases, what I've been trying to do is resolve it by phone rather than wait for them to, get it in the mail and get it processed, because it's, I think with our clients is we're seeing about an average of 3 or 4 months on something like that, where normally, that would be resolved within, a month or so. But one of the things we can do, if I can't get it resolved that day, when I do get an agent on the phone, if we can't get it resolved right then we ask them, can you please freeze their account so we can have more time? And they usually allow that. But otherwise, we got to wait for them to process the information. Some things like if it's like a late notice or something like that, a lot of times I can resolve that on the phone because I can fax something right to that agent, whatever agent I have on the phone. It just depends on what it is.
Thank you.
Okay. So we had one more topic to cover. Okay, and it's kind of something that's affecting the 2022 year. So 1099Ks, they've changed the reporting threshold for this. And the former threshold was about $20,000, and now they've changed it, dropped it to $600. So a 1099K is a reporting income from a third-party network. So this is like your credit card processors, like PayPal. PayPal is a great example. So if you sell something on eBay and you have more than $600 in sales this year, chances are you're going to get a 1099K for your sales. And this is going to come from PayPal or whatever credit card company is processing that payment. So this is going to end up affecting people who sell items on eBay or Etsy, or they've got a little side hustle. And this is a pretty big change. It's potentially going to catch a lot of people off guard. So if you're concerned about the effects of this change, you might want to let us know so we can help you determine, how it's going to affect you and maybe what can be done about it. So, just be aware, if you sell on Etsy, you sell on eBay, you've got some little side hustle where maybe you've got a Square device hooked up to your phone so you can take payments. That's the kind of stuff that it could possibly show up on a 1099K if it's over $600. So, and then if it shows up on a 1099K, the IRS is going to expect to see that number on your tax return.
So Heather, you said that this is on the horizon for 2022. Does that mean that is happening now?
So yeah, it basically is happening now. Anything from January 1st to 2022 to the end of this year is potentially going to get reported on. You get that form next January. And there's say 1099K, and it'll have 2022 on it. But like I said, this is it's only on sale 600 or more. But we want to make people aware of this because maybe if you were some people even they sell garage sale items this way, or they've got, like I said, they're selling some stuff on Etsy just as a hobby. That's something they need to be aware of because they need to understand what the tax rules are on that.
All right. I think that concludes everything that you guys wanted to cover today.